All right, ladies and gentlemen, it appears that the Federal Reserve may be concerned about something. They've injected $500 billion into the standing repo facility. And they claim to be doing so in the terms of testing and technical exercises for the purposes of increasing the Fed's understanding of how the standing repo facility operates during times of great market stress and volatility. They're doing this from December 30th through January 3rd, 2025. So we're looking at a few days here. Now, I want one thing to be clear. There are two sides of the same coin here. One is the repo operations market. The repo is injections of liquidity by the Federal Reserve in order to bail out banks and provide liquidity. The other is the reverse repo, and that is draining liquidity from the system. So what you see here on the left side of the screen is the reverse repo, which of course you can see has been coming downwards for a significant period of time. This is draining liquidity from the system. On the right-hand side, we're talking about the repo operations, in which for the next few days, the Federal Reserve is injecting $500 billion into ensuring safe operations through the banks. But the reality of the matter is that there's something more at work here. You can see the reverse repo soared today from yesterday's $213 billion to $474 billion today. Here's the reverse repo numbers for today. You can see them clearly on my screen. Over 80 counterparties. This is the highest we've seen since June on a year-end window dressing and funding shortage. Now, it's called window dressing because this is literally cooking the books by the banks. All right, the banks here, I'm going to turn the volume down just a little bit. The banks here are cooking the books in order to make everything appear to be in order. That's not the case. There's a reason that at the end of every single quarter, the reverse repo number jumps. Look at here, December of 23, massive jump. March of 24, the end of Q1, jump. Second quarter, jump. Third quarter, etc. And now at the end of the year, on the final day of the year, the banks have to cook their books. And at the same time, we've got the Federal Reserve injecting $500 billion in liquidity in order for that to be able to be possible. They're working together in conjunction to make sure that they can pass their stress tests, right? But they're all basically having issues. Everywhere, all the central banks and all the major banks from the United States across to China are having some huge issues right now. All right, and this is talking about the issues in China. So let's talk really quick about China and the United States. The People's Bank of China injected 580 billion renminbi, right, Chinese money, last week into the reverse repo operations at a fixed rate of 1.5%. This provides them short-term relief and gives them, it follows the aggressive drain of liquidity that they've recently had. And the liquidity around the world is deteriorating, and the Chinese economy is under significant pressure. So they're going to be possibly seeing stronger potential measures in 2025 if the DXY, the dollar index, weakens and the Fed stops QT and begins quantitative easing, which we all know that that's probably going to happen. The Treasury General accounts, however, here in the United States, the TGA has declined by $104 billion this past week. So the year-end financial conditions are tightening due to the balance sheet adjustments by these banks and large institutions, not just banks. So the TGA drawdown offers short-term relief to funding markets as well as the $500 billion injected by the Federal Reserve. So with quantitative tapering and elevated SOFR rates still putting pressure on the markets, the broader liquidity environment remains tight, even though financial conditions are pretty relaxed in general. So the sustained drawdowns in the Treasury's general account, think of it as the bank account for the United States Treasury, are critical for any meaningful liquidity improvements for next year. So it's necessary here for the Fed to start quantitative easing measures in order to address the problem that we're currently having with debt in the United States being at the highest level ever, and our interest payments on that debt being at the highest level ever as well. So this week alone, the global liquidity index dropped by 0.5 percentage point. Liquidity momentum remains weak. The rejections for mortgages and auto loans, for example, has jumped to over 10%, which is the highest we've seen in over 10 years. All of this coincides with the fact that banks are having trouble lending money as of this very moment because of the lack of easy liquidity. Again, on the left side, we're looking at the reverse repo. On the right side, the repo operations. This is the difference between draining money on the left and adding money to the system on the right. They're doing a juggling act right now. The Federal Reserve is juggling in a repeated fashion in order to try to maintain fiscal stability between these banks. So you can see the reverse repo has been dropping very, very quickly over the last few years. And at the end of every quarter, being today, especially the end of Q4, we're seeing that happen right now. We saw it reach $473 billion, but that is down significantly from where it was, if you see on my screen here, just a couple years ago here in 2023, the number was $2.6 trillion in the reverse repo operations. After the debt ceiling was lifted in January 2023, that went from 1.8 trillion to the current, what it was a couple of days ago was under 100 billion. Today, of course, with the injection of the liquidity from the Fed, the banks cooking their books, trying to make everything look as good as possible, right? This is window dressing after all. You can see that there are some significant issues here, and the banks have to make themselves continue to look solvent and in strong form. Just adjust this a little bit here for you guys. So in regards to the standing repo facility here, adding 500 billion, that allows the Federal Reserve to provide short-term liquidity to banks and financial institutions by purchasing United States treasuries, debt, mortgage-backed securities, and they have an agreement to sell them back later. So they're bailing out money. They're bailing out nearly $500 billion per day. They leave some of that money they can use in the morning, and the other half they can use in the afternoon, because there's an extra step here to the repo facility right now. They're trying to stabilize money markets and mutual funds and such, and they're adding morning operations from 8:15 to 8:30 a.m. That's what this says right here. That's what this means. In addition to the regular afternoon operations from 1:30 to 1:45 from December 30th through January 3rd. This is intended as a technical exercise and testing to understand how to adjust the standing repo facility timings in order to bail out banks when they collapse. And of course, money market funds, especially during periods of potential stress in money markets like year-end financial pressures. So they've added morning operations to the afternoon, increased the maximum daily limit for both operations to $500 billion per day. So for example, if they use $200 billion in the morning operations, they have an additional $300 billion that they can use in the afternoon operations. Each counterparty can submit 2 propositions per eligible security type. As we said, treasury bills, the mortgage-backed securities, etc., with a $20 billion limit per proposition. So they can use agencies' debt, etc., as I just stated as well. And primary dealers and other institutions like depositories can do so. And they can do so twice a day. So they are trying to enhance their ability to bail out financial markets during market crashes. That's exactly why they're doing this stress test right now. They are supposedly temporary and don't affect normal operations. And for now, they will be temporary. At some point, they won't be, because the adjustments to the standing repo facility in December and January of this year are indirectly related to the repo market disruptions of September 2019. Let me Google that for you real quick so you can see what happened to repo operations. On the morning of Tuesday, September 17th, interest rate on overnight repo transactions experienced a sudden and unexpected increase. During the trading day, interest rates on overnight repo went as high as 10%, and it was at 2%, by the way, with the top 1% of transactions reaching 9%. At that point, on September 19th, 2 days after this began, the Federal Reserve had to step in and permanently take over the repo operations and the reverse repo operations permanently from the banks. And that is what we're beginning to see here. So there was a spike in repo rates in mid-September of 2019, where the cost of borrowing by pledging securities as collateral unexpectedly spiked from 2% to 10%. Okay, this disrupted everything. The markets, which are a critical component to the financial system, where these banks and institutions borrow and lend their short-term cash. So corporate tax payments were due, large settlements of treasury auctions reduced the available cash in the system. And at the very same thing, that's what we're seeing right now with the reverse repo. You're seeing the reverse repo be drained as the Treasury and the United States government does not have sufficient number of institutions and central banks to buy our large issuances of T-bills right now. So a lot of them are being bought up by mutual funds. That is why the drain from the reverse repo has gone from 2.6 trillion a couple years ago down to basically 100 billion today. And what you're seeing, even 12 months ago, that was at over $1 trillion at the end of 2023. Now at the end of 2024, that number is less than half of that at what we're seeing today at 473 billion. You will see this again on the next business day be under $150 billion. Overnight, this will drop by 70% or so. And that is only because today is being used as the end of the quarter in order to cook their books for the banks. So there was an unexpected liquidity demand by those banks, as I said. And now it's kind of what we're seeing right now also. There was a reserve scarcity in which banks were holding fewer reserves than needed in order to meet these unexpected spikes in demand due to the Federal Reserve's efforts to reduce their balance sheet. And again, that was quantitative tightening in 2019. What happened? The market dynamics, the financial institutions preferred holding reserves over lending them out. And this exacerbated the liquidity shortage. And they had to continue to do so in order to maintain their collateral on heavily shorted equities and other things that could potentially get the margin called. The Federal Reserve conducted emergency repo operations to inject liquidity into the market, providing cash in exchange for treasuries and other securities. And then later, of course, that happened September 19, 2019, the Fed began purchasing treasury bills to increase reserves in the banking system on a more permanent basis. So what we're seeing here is the beginning of the same sort of collapse that we saw in September of 2019 in the money market mutual funds and in the repo operations. Now, I'm not saying that the markets are going to crash tomorrow. I'm not saying they're even going to crash this month or even next month. I'm saying that the quantitative tapering is going to stop and the quantitative easing will begin even further. This will lead to further increases in levels of inflation, and that is obviously not a good thing for the majority of people. So the standing repo facility was introduced in July of 2021, which was a response to the lessons learned from the 2019 repo market stresses. And it's designed to provide liquidity on demand, stabilize short-term markets and funding. It acts as a backstop to ensure that smooth market functions and avoiding liquidity crunches that we saw. So right here, the Federal Reserve, the correlations here are that they are anticipating stress in the repo market because of these increased funding pressures, similar to the conditions we saw in September of 2019 due to the tax payment settlements, the settlements of securities, the reduced bank activity, etc. And the Fed is using this period, this 4-day period here, 5-day period, to evaluate how different timing of repo operations can impact the liquidity provisions and market functioning so they can bail out these banks or money market funds anytime that there's a collapse. They're trying to avoid a repeat of 2019 by proactively providing tools like the standing repo facility and adjusting their operations in order to ensure the financial system has sufficient liquidity during times of heightened demand. So what we saw in 2019 in the repo market stressed highlighted vulnerabilities in the short-term funding system when reserves became scarce. And the Federal Reserve had to introduce this standing repo facility in 2021 and took over the 2019 repo facility as well. Now you can see that they're injecting funds here further, and these adjustments reflect a proactive approach to managing liquidity during what the Federal Reserve believes to be upcoming disruptions and stressful periods in financial markets. So, ladies and gentlemen, let's just say that they smell something cooking. We just don't know exactly what that is. Financial issues likely lie ahead. Quantitative tapering will likely be reduced even further, if not stopped entirely. And quantitative easing, the printing of money by the Federal Reserve, is probably coming pretty soon. We'll see how inflation roars in its wake. I'll leave you with that, ladies and gentlemen. I don't want to make this video too long. I know it's a lot of information, but I just want you to keep in mind, don't fight the Fed. Don't fight the Fed. We all understand that a lot of this is a big Ponzi, and we are in the largest bubble of asset classes we have ever seen in the history of the world. But we can't fight the Fed. The markets will do that for us on their own. As you can see, the Federal Reserve began to reduce interest rates a couple quarters ago. And what happened to mortgage rates? The opposite of what should have happened. They didn't follow the Fed funds rate further down. The Wall Street and the banks said, yeah, there's no way that inflation's going down right now. We need to increase mortgage rates further. And that's exactly what happened. So we can't fight the Fed. We have to work with Wall Street. We have to work with the Fed in order to figure out what is going on so we can continue to make money, to be profitable, and then take advantage of it when things do go awry. Cheers, my friends. Big Ace, Luke, Dustin, AMC, Everlong, Desert, Tony. Ladies and gentlemen, I really appreciate you for joining me. Quant Trades, Black Widow, Zachary. If you guys have not looked into Lit Exchange yet, we are creating an upcoming stock and crypto brokerage. And for the first time in history, you can own the company. No stock and crypto brokerage has ever allowed non-accredited retail investors, regular everyday people, to own part of the company before their launch and IPO. And we're giving you that opportunity right now. So this is the first time in the history of the world that any company's ever done this. And let's put it this way. In a few years here, when we IPO and you see what the stock price is then compared to what you could have gotten it for now, you're probably going to be kicking yourself in the ass if you don't decide to invest now. Private equity offers opportunities that the stock market never could. Cheers, ladies and gentlemen. I wish you peace and wealth. Happy New Year. Kendall Price says, my next check, I'll be investing in Lit Exchange. I look forward to partnering with you in this endeavor, my friend. We are here to change financial markets. We are here to avoid payment for order flow and price distorting dark pools. We are here for transparency and to help retail orders hit the Lit Exchanges and stop being front run by high frequency traders, market makers, and hedge funds. Cheers, my friends. Cheers, Kendall.